Alright guys, so welcome back, and then we are going to continue our session. So we are going to talk about swing points, right? Swing point, and mind you, swing points are also liquidity areas, right? So as I said in the last video, I forgot to mention about these areas when I was talking about liquidity, so we are going to go over them, right? So what is a swing point, right? So we have two types of swing points, right? We have a swing high and a swing low. So the idea is that traders are likely to put their stop losses at swing point, and so that means that there is liquidity at those levels because of the orders, right? So how do you identify a swing point? It's very simple. So as I've indicated here, this is a swing high, right? So with this swing high, what makes it a swing high? First of all, it is a high, right? So let's say a higher high, right, in an uptrend, right? So you see, the reason we call it a swing point is that any swing high, right, any swing high has a high to the side and a high to the other side, right? So it has a high to the left and a high to the right, and then that specific thing that makes the swing high is that it is in the middle of those highs and it sticks out. So we have this candle right here, we have a high that is lower to the side, and we have another high or candle that is lower to the side. So a swing point or a swing high is a three candlestick formation whereby the candle to the left is lower than the candle in the middle, and the candle to the right is also lower than the candle in the middle. So this is a swing high. So that's what makes a swing high. So we have another example here. You see this candle right here, this directional candle. So we have this candle, and then we have this specific candle. So if you can see, we have another candle to the right, which is this candle, and you see this candle and this candle to the left are lower, right? The high of these candles are lower than the high of this candle. So this candle sticks out, and that is what makes it a swing high. So therefore, this right here is also a swing high. Do you get it? This is a swing high. Good, because right, we have this high here. You see, we have a high to the left, which is lower, and another high to the right, which is also lower, and then it makes this one sticks out. So we talk about swing lows, and it's the same thing too. We have a low to the side, so this is the low of that candle, right? The low of that candle here is it, and then we have the low of this candle too, and both candles lows are higher than the candle of this middle candle. So in that case, it makes this one sticks out. So when it's sticking out like this, it makes it become a swing low. Another example of a swing low, we have this candle right here. So this candle's low right here, okay, we have this candle's low right there, and we have this candle's low right here too, and then in the middle we have this candle's low right here, which is lower than these two candles. So it makes it a swing low. Now what makes something not a swing point? You see, when I was talking about the lows, I talked about a candle to the side that is either higher, both candles to the side being higher, or both candles to the side being lower. Now when you look at this candle right here or this candle right here, you see it is not a swing high, because this candle right here, even though it's higher than this candle right here, you see the next candle right to it is also lower, right? So this candle is lower, this candle is higher than this candle, and then the next candle is also higher than this candle's low. So it doesn't make it, so nothing sticks out here. Do you get it? And same applies to the swing highs. Nothing sticks out here. So nothing sticks out because this candle right here is high, first higher than this high, but then this candles right here high is also higher than this one too, and then this one's higher than this one's higher than this one, so it makes it what? Not a swing point. Now let's talk about this. You see, this one is a swing point. Why? Because the candle beside is right, the left candle, its high is lower than that high of that candle, and then the next candle, which is the right candle beside it, its high is also lower than the high of this candle. It makes it a swing high. Do you get it? This is a swing low, right? This candle right here is a swing low. Why is it a swing low? Because the low, the left candle is higher, right? The low of the left candle is higher than its low right here, and the low of the right candle is also higher than this low right here, so it makes it do what? Stick out. So there are a bunch of swing points that I didn't mark because I can't mark everything, because it's all over the market, right? It's all over the market, right? And you see, one thing I forgot to mention is this is also a swing low. This is also a swing low. Why? Because there is a low to the side which is higher than it, and another low to the side which is also higher than it, so it makes this one stick out. But why do we not consider this a major swing low? Is because we have a major or another swing low which is more relevant. So we'll talk about relevant lows and highs. You see, the reason this is relevant is that this is coming from a fair value gap, so it makes this one more trusted than this one. So you just don't mark any swing low, you mark lows or highs that are, you know, relevant, that can be easily seen too. Okay, so this low right here is also a swing low. This low right here is also a swing low, because we have a low to the side which is higher and another low to the side which is also what? Higher. So it makes this one sticks out and it becomes a swing low. Another swing low right here, we have a low to the side which is higher, another low to the side which is higher, and then makes this one sticks out. I hope you are getting the memo now, right? So if this candle closes right here, if this current candle closes, then this will become a swing high, because we have a candle to the side which is lower, right, and the high to the side which is also what? Lower than this one. So it makes this one sticks out, and then it becomes what? A swing high. So swing points are very easy to identify on the market, and that is what makes liquidity too, right? So these places are also a place of liquidity, because every swing high or every swing low are either a previous day's high or a previous day's low, or a previous week's low or a previous week's high. Listen to what I'm saying very, very carefully as part of liquidity areas too. Previous day's low. So this is a daily candle, right? This is a daily time frame. All these lows and highs of the daily candles, right? All these lows and highs that I've marked, right? This high right here that I've marked, they are all areas of liquidity. So every single day when a day is closed, right, its high and its low is also areas of liquidity that price can either use to reverse, right, or then run over. Are we getting it? Yes. So if you go to the weekly time frame, right, let's see the weekly time frame, the previous week low or the previous week high. So let's say this week's, right, this previous week high right here, this previous week high was what? An area of liquidity, and then price ran over it, and its low too, which cannot be seen, it's also an area of liquidity which price can attract to, okay, which can attract price in the future. So what I'm trying to say is that the higher the time frame, the higher the liquidity. So if you are using a previous day, a previous day's candle high or low as a liquidity to frame your trade. That means that when you go into the 1 hour time frame, the previous day's low or high is more is stronger. Okay, it is stronger than the 1 hour time frame candles high or low to frame the trade. I don't know if you get what I'm saying, but the higher the time frame, the more probability that the candles high or low is more has more liquidity. When you go into the 1 hour time frame like this, right, you see the previous candles high to, right, the previous candles high to, like this candles high, can be used to frame a trade too, right? It can be used to frame a trade too. For scalpers, they use it. People that scalp on the 1 minute time frame or 30 seconds time frame, all of that, they can use this one to frame a trade too. So when price takes this high, they expect price to do what? Come to this level or come to this level. The previous candles high or the previous candles low. So aside highs, aside higher highs and higher lows, and then trend line liquidity and all of that being areas of liquidity, every single candle high or low can be used as liquidity tool, or it is liquidity tool. That's why the daily time frame, the 4 hour time frame, the weekly time frame, candles high or low can be used to frame. So the higher the time frame, okay, the higher the time frame, the higher the attraction. Do you get it? The higher the time frame, the higher the attraction, the higher the confluence. Good. So I hope this lesson was quite understandable, talking about the swing points and the previous day high or previous day low, right? So our next session is going to be on fair value gaps, right? Fair value gaps. So what is a fair value gap? Right, a fair value gap is a 3 candle pattern, right? A 3 candle pattern where the first candle, right, the first candle high, the first candle's high or low doesn't overlap with the third candle's high or low. So what do we mean by this? You see, a fair value gap is a gap in the market, right? A gap in between candles, more like a space. You see, let's use this area for an example. This specific area, ignore this fair value gap right here. This specific area, you see this candle, and then this candle, and then the next candle. You see, there are no gaps between them. You see, when you check this candle's high and then you check this candle's low, you see that there is no gap here, right? Because the wick has covered that gap. And now, as you can see, there's no gap here because there is a wick, and then this gap, this candle's high right here, then this candle's low too. There is no gap here because the wicks have covered, or the wicks have overlapped, right? So there is no gap right there. So when we talk about fair value gaps are gaps that are left in the market because the market moved too fast, right? So when the market moves too fast, it creates a 3 candle pattern called a fair value gap. So how to identify a fair value gap is that the first candle, which is this candle, right? We say it's a 3 candle pattern, so we have candle 1, candle 2, and candle 3. So the first candle, which is the candle 1, it's low or high, right? So this is the bearish fair value gap. Its low does not overlap with the third candle's low, like how these have. So this candle's high shouldn't have overlapped with this candle's low, and then we would have called it a fair value gap because there would be a gap between them. But since it's overlapped, there is no gap between them. But looking at these candles right here, you see the low of this candle and the high of this third candle didn't overlap, right? They didn't overlap. And what do I mean by that? You see, let's say this the wick of that candle, right? And then this is also the wick of that specific candle. You see, they now overlap. That means there's no gap between them, right? So since they do not overlap, it creates a gap between the candle that moved faster. So it creates a gap between the first candle and the third candle due to the candle 2 that moved faster. So a fair value gap, right, is a 3 candle formation whereby the first candle can do whatever that it wants, but the second candle is usually a displacement candle or a directional candle, a candle that that is, more stronger, a stronger candle. And then the third candle too, normally a consolidation candle, or it can also be any other candle. So this is an example of a bearish fair value gap, whereby we have a candle 1, which can be either a bearish fair value gap, a bearish candle or a bullish candle. The candle 1, we have candle 2. The candle 2, if it's a bearish candle, that means that a candle 2 should be a strong bearish candle. And then the candle 3 can also be either a bearish candle or a bullish candle. But then the important thing is that the highs and the lows of those first and the third candles should not overlap, because when they do not overlap, they create a fair value gap. What does that mean? The market moved too fast to the sell side. See, from right here, the market was bullish, right? Then it moved too fast, created a strong bearish candle. Now when this bearish candle got created, it means the market moved too fast, so it gave the chance for sellers to do what? To sell. But then buyers did not have the chance to do what? To buy too. So now it creates that fair value gap, so that price will then return to it to give buyers the chance to also buy into that fair value gap. And then it later moves on to its direction, either going straight to that bearish direction or moving past the fair value gap to either do whatever that it wants. But then the idea is this fair value gap, right? So we have a bullish fair value gap too. Now it's the same thing as the bearish, but then this is the opposite, right? So we have the first candle, right, which can do whatever that it wants. The second candle is a strong a strong directional bullish candle. And then the third candle also does whatever it wants. It can be any other candle, right? So the gap between the high of the first candle and then the low of the third candle, that gap in between them is what we call a fair value gap. So when we're marking a fair value gap, you mark a fair value gap by marking, right, by connecting the candle, the high of the first candle, then you connect it to the low of the third candle. You extend it, right? So when we extend it, when price comes back to this level with further confirmations, you expect it to do what? To move higher. Okay, so that is how you mark a fair value gap. Let's try again. The high of this candle to the low of this candle, extend, and then that's it. So for what is the importance of a fair value gap? The importance of a fair value gap is that the market should use it as a support or a resistance area. So when the market is moving higher, you expect the market to respect bullish fair value gaps, right? The bullish fair value gaps, you expect the market to respect them. What do I mean by respect? You expect the market to come into that fair value gaps, and then when it comes into it, you expect them to move away from it, or you expect the fair value gap to push price higher. Since the market is moving upwards, you expect the fair value gaps to support the price higher. And then when the market is moving downwards, you expect the fair value gap to support lower prices. So when price comes back into the bearish fair value gap, you expect it to do what? To move lower. So as you can see here, considering how these candlestick formations are, you can see that price came first into the fair value gap, closed outside, right? And then the second time to went into it again, and then closed outside and moved downwards. So it means that the fair value gap is supporting lower prices, same as the bullish fair value gap. When price came back into it, moved into it, closed outside, and then it moved price upwards. So bearish fair value gaps are resisting price from going up, right? So they are supporting lower prices, and then bullish fair value gap are supporting higher prices, which means that when price comes into them, they are meant to push price higher when it is in an uptrend. So this is another fair value gap, right? As in price, when price came back into that fair value gap, around that bullish fair value gap was mitigated, right? When I say mitigated, it means that price tapped into it, right? So when it was mitigated, when it was triggered, the market did what? Moved higher. Same again, this is another fair value gap. This fair value gap wasn't traded into. This fair value gap right here, when price traded back into it, it did what? Moved higher. We have another fair value gap here, which I didn't mark too, right? From this candle's high to this candle's low right here, there is a fair value gap. When price came back into it, it did what? It moved higher. So what I'm trying to tell you is that a fair value gap can act as a support or a resistance to price. Do you get it? It can. Doesn't mean that it should always do that, but then it can. So you can use a fair value gap as a confluence, right? So when the market is moving higher, you expect the fair value gaps that price is creating, right, to move price higher too. And then when price is moving lower, you expect the fair value gaps that price is creating to move the price lower too. So this fair value gap again, price tapped into it in an uptrend, moved higher, and you can see that is how it happens. So that is what we call a fair value gap. So we have a bearish fair value gap and a bullish fair value. So this is an example of a bullish fair value gap. Once again, a bullish fair value gap is when the high of the first candle and the low of the third candle do not overlap, and then the second candle is always a strong candle. It should be a strong candle, right? It should be a strong candle so that it will indicate that price moved faster. You see, for a fair value gap like this, I'm not going to trust it that much, even though I could use it. I'm not going to trust this one that much because the price didn't move faster, right? So it makes it less probable. But when it comes to this one, you realize that price actually moved faster from that area. So when price comes back to it, the probability that it's going to actually reverse from this area and then continue its uptrend is very, very high. So then a bearish fair value gap is also the opposite, whereby it pushes price lower. So a bearish fair value gap, the candle 1's low does not overlap with the candle 3's high. So the gap in between them is called the fair value gap, and that makes it the bearish fair value gap. Displacement, right? A strong bearish candle. Price then returns to it and then do what? Move lower. So you see the fair value gap, that's a bearish fair value gap, is supporting lower prices. All right, so thank you very much, and then our next lesson is going to be on, we are moving more towards understanding everything about ICT, and then soon we'll be getting to the model. So we're talking about order blocks in our next lesson. So first, we'll talk about change in state of delivery, right? And then we'll move on to other blocks. When we say change in state of delivery, what is change in state of delivery? As the name suggests, it is a change in state of delivery. So it could be a change in state of delivery from bullish to bearish, right? Or a change in state of delivery from bearish to bullish. So now let's look at how or what a change in state of the delivery looks like. This current candle right here, right? This current candle that we have right here, it's a higher time frame candle. Now, from the lessons that we've learned, we realize that this candle is a reversal candle, right? Which indicates a reversal in the market. So now when we see a candle like this, what we want to do is that we want to confirm if it's actually a reversal candle. So after price takes liquidity, right? So as you can see, after price took the liquidity here in this candle's high right here, so this previous candle high, right? As I said, previous candle's highs can be used as an area of liquidity. So price went above it, right? This candle went above it and then came inside. So we call it sweep of liquidity, right? Single candle sweep of liquidity, whereby the candle went above the previous candle and then it closed inside. So it has swept the liquidity. That means that it has taken the liquidity there. So it has formed a reversal candle. Now we want to confirm the reversal candle, right? We want to really confirm if the market is reversing. So how we confirm the reversal candle is with the change in state of delivery. We can confirm with a market structure shift too, but in our lesson we'll be confirming it with a change in state of delivery. So then we'll go into the 5 minutes time frame. This is a 1 hour time frame, so we'll go into a lower time frame, let's say the 5 minutes, right? And then in the 5 minutes you are going to confirm the change in state of delivery. So one may ask, what is the change in state of delivery here? You see, when that 1 hour candle went above these highs, and when we're talking about liquidity too, you realize that we talked about equal highs too. All these highs right here, this high right here, this high right here, and then this high right here, they are called relative equal highs, right? They are almost equal. They are almost equal, right? So price went above them, right? There are a lot of liquidity there on the 5 minutes time frame too. So even though on the 1 hour it was the previous candle, on the 5 minutes there were a lot of highs there too. Price went above all these highs and then it changed state of delivery. Now how do you confirm the change in state of delivery? The change in state of delivery is when price closes, right? When a series of candles, right, either a single candle or series of candles takes liquidity, right, or runs above a liquidity, right? So it takes liquidity and then the market closes below the opening candle of those series of candles, right? So you see, this is the opening of that candle. Let me go over it again. When a series of candles, right, series of candles, so it's not supposed to be bearish and bullish candles. It's supposed to be either bearish candles or bullish candles. When these bullish candles went above this candle's high right here, okay, these highs right here, there are series of bullish candles. So this is a bullish candle, this is a bullish candle, this is a bullish candle, this is a bullish candle. They went above this specific high right here, and then the market closed below the opening of the first bullish candle that started that run above this liquidity. So when the market one goes up and then closes closes below the open of that candle, so the candle opened right here, right? It opened here. When we talked about open, low, high, close, what we meant was that when the market will open here for a bullish candle, right? So it opens low, creates the low, creates the high, and then closes, right? So this specific first candle is what started this 4 bullish candles that we see right here, right? That runs the liquidity high. So goes up and then the market quickly closes above those candles. So you see how fast it was. It went up and then closes above the opening, right? So it closes below the opening of the series of those candles, right? So we call the series of up close candles, right? This series of up close candles runs above liquidity, the market closes below them. Now we've confirmed that the market wants to reverse because the liquidity has taken, and then we have a change in state of delivery. So the change in state of delivery happens when the market closes below the series of those up close candles. So this is a bearish change in state of delivery, right? So then what happens when it changes the delivery? Then we know that the market does what? Wants to go lower because there has been a change in state of delivery from bullish to now bearish. Okay, and then whilst we are at it, we are going to talk about other blocks. This change in state of delivery that I just marked, right, whereby the price went above a liquidity high, right? Price went above a liquidity high, market closed below the opening price of that series of candles, right? When the market closed below them, these candles are called other blocks, right? They are called other blocks. These candles are called what? Other blocks. So the other block is not just one candle that you see here. It is the series of all these bullish candles that we call one other block, right? But then since it's the first one after the liquidity was taken, we refer to it as a change in state of delivery. That is another block, but also the change in state of delivery. Now, what is an order block in its sense? So you see the market then, after closing below this, what did the market do? The market went up again into what? Remember the last lesson? Into this fair value gap. So when the market went into that fair value gap, we also have a single bearish bullish candle that goes beyond these or all these candles, right? So it takes the high of that candle into that fair value gap. So when it takes the high of that candle into that fair value gap, you see it's a bullish candle. So when the market closes below that candle, then that becomes your order block. So when we are bearish, right, and we've confirmed our change in state of delivery, and then the market then moves upwards. It moves upwards like this, right? The last or the series of up close candles, that's the series of these bullish candles that make the market move up. When the market closes below the opening price of that candle again, as the change in state of delivery happen, if it closes below the opening price of that candle again, that bullish candle or that series of bullish candles now becomes your order block. And since we are bearish, we expect that order block to do what? To move price lower. Okay, to move price lower. So let's see what happened here. You see, it took a while, but then it later went lower. Do you guys understand? So you see, we confirm the reversal with a change in state of delivery right here, whereby I say a change in state of delivery is when the series of up close candles that takes a liquidity high gets closed below at the opening price, at its opening price, right? The opening price of this series. So if these candles were not series of bullish candles, and let's say they were bearish, this one was a bearish candle, that means that the change in state of delivery would have happened when price closes below this level and not this, because this one would have been a bearish candle. So when the market closes below its opening price, now we have the reversal, right, confirmed. And then the other block is the series of up close candles, or the up close candle that goes into a fair value gap or a relevant level. Now the relevant levels that we are going to use is a fair value gap or a high. Okay, so now we have a fair value gap and we have the high here. So now we have two confluences. So it takes the high of that previous candle, and then there's a fair value gap right here, and then after that happens, the market does what? Closes over the series of those candles. So now your other block is expected to push price lower, and then when price comes back to it, you see how price reacted: rejection, 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 and then it started melting. So this is a bearish change in state of delivery, right? A bearish change in state of delivery and a bearish order block. So we're going to talk about a bullish change in state of delivery and a bullish order block. All right, so we have a bullish example here, right? So notice this fair value gap right here. This is what? A bullish fair value gap. So when the price or the market or the candles comes into this fair value gap, what do you expect? We expect it to move higher, right? Good, that's what we are expecting. So now we are expecting either the next candle or the next candles to move into this fair value gap, right? So let's go on to the next candle. Good. So this is what happens. Right from the open, the next candle moved into that fair value gap, right? And you can see it took the previous candle's low too. And what did it do? It moved into that fair value gap, reverse. So this is a reversal candle. This is a reversal candle. So we need to confirm the reversal, right? As I said, we use change in state of delivery to confirm reversal. So we need to confirm the reversal. Now, how do we confirm that this candle is actually a reversal candle and then market wants to move higher? We go into a lower time frame after we let the higher time frame candle form. So this is the 1 hour, so we are going to move into the 5 minutes or any lower time frame candle. So when we go into the lower time frame, what do we see? We go into the lower time frame. Good. So we have the fair value gap there. We have the fair value gap there. And this is the previous candle's low in the lower time frame. Okay, so the 1 hour candle took this candle's lower. So this was the previous candle's low. So the 1 hour candle took its low and entered that fair value gap. So now we are in the 5 minutes time frame. Good. So in the 5 minutes time frame, we are trying to confirm the reversal by changing state of delivery. So now we are going to confirm it. You see, these are all bearish candles, right? These are all bearish candles. So they either took the high. You see, in the previous candle I used a high, right? I used the previous candle's high, but this time we are using what? A fair value gap. And we have also a previous candle's low too, but we are using the fair value gap, right? That is the important level. When price came into that fair value gap, we realized that there were a series of bearish candles that went into that fair value gap right there. So 1, 2, 3, 4 bearish candles straight into the 1 hour fair value gap, and then price did what? Closed over them here. So you see, this is the opening price of that candle. You see where it's open, right? You see, so for a bearish candle, it opens high, creates the high, low, creates the reach, and then closes. So the opening price right here, when price closes above that opening price, that is what we call a bullish or change in state of delivery. We have a bullish fair value gap right here. So this series of down close candles, right, when they came into that fair value gap, and then the market then closed over them with bullish candles. You see, it closed over them with bullish candles, right? So the series of down close candles into a fair value gap, or running a low, right, liquidity low, and then price closing over them. That is what we call what? A change in state of delivery. So this is a bullish change in state of delivery. Bearish candles, series of bearish candles into an important level, price closes over them, right? Price closes over them. Now we have confirmed the reversal in that 1 hour time frame. So now we are sure that there's a higher probability of markets doing what? Going further upwards, right? So we do not expect this low right here to be revisited soon. We don't expect it to be revisited right now, right? Good, because we've confirmed the reversal, and it means price wants to move higher rather than coming back to that low. I hope you get it. So you see, in this instance right here, the market almost went over that high, but then it closed below it. That is not a change in state of delivery. You need to wait. So this candle right here is what caused the change in state of delivery, because this candle is what closed what? Above the opening price of the series of those candles. So when it closed above it, now we've confirmed what? So this becomes your change in state of delivery, and that means that's the order block, right? But since it's the first one confirming the reversal, we call it a change in state of delivery, because we are changing state of delivery from bearish to bullish. Now in this same market, let's try to find our order block. So we let it play. Oh, that was fast. That was very, very fast. So for the order block, as I mentioned earlier, mind you, this is not an order block. You see, we have a fair value gap right here. Fair value gap. And then this candle, right, this down close candle, right, this bearish candle moved into that order block, sorry, that fair value gap, and then the next bullish candles did what? Closed over that candle's open too. So you see, this candle's open right here, it got closed over. So now this becomes the order block. This whole candle becomes the order block. So when price comes back to this order block, we don't expect it take much time around this area. You expect it to do what? To move higher. So the moment price closes above the opening price of the bearish candle, you expect it to move higher. Now this candle right here is not an order block. Why is it not an order block? Because we hadn't confirmed the change in state of delivery yet. So because the change in state of delivery hadn't happened, it means we were still bearish. And if we are still bearish, you cannot say this is your bullish order block because we are still bearish. We haven't moved to bullish yet. Now this is what is the real order block, because now we have the reversal confirmed by the change in state of delivery. Now we have this bearish candle coming into an important level, that is the fair value gap, and then price closing over it, this bullish candle right here, closing over the opening of that candle. And what does that mean? It means that we have an order block, and then we expect the price to move higher. Either it comes back to it or we enter. So one can decide to enter from the next candle open. That's if this candle closes right here, one can decide to enter, right? And then put your stop loss below the candle that the order block is low, right? You put your stop loss below it, and you say you're targeting 1:2, right? Good. So let's see what happens. Then as you can see, exactly the price did what? Move upwards. Do you understand? The price moved upwards. So that is an order block. And then the change in state of delivery. So now we'll go over the PDF to actually confirm it properly for ourselves. Maybe like this one was quite, maybe you didn't understand this well. I have the PDF too for you to see the pictures properly. So we'll be talking about the order blocks more here. You have a few change set of deliveries there, right? So by the way, these are from T-Trace, right? T-Trace is my mentor, a person that I really cherish so much. He's one of the reasons that I'm here. Okay, his content has really helped me, being a good trader. Now let's talk about the order blocks. You see, this is a change in state of delivery right here. Why is this a change in state of delivery? Because you see this low right here, it gets taken by this candle, right? So this candle took out the low of that candle. So what did I say about lows? They have liquidity. So this low got taken by this candle. Now you see the series of these candles, right? The series of these bearish candles, 1, 2, 3. The open of that candle right here, right? From that open to the close right here, it becomes on an order block when it gets closed over. So when the open gets closed over, this becomes your order block, right? So this is the change in state of delivery, right? So that's the first one, the change in state of delivery. Now we have invalidation here, because now when the price comes below this area after the change in state of delivery, it means that your setup has been invalidated, and that means that your setup wasn't valid, right? So now this change in state of delivery confirms the reversal. Now what is a continuation order block? So after the change in state of delivery, we have a fair value gap that was created. A fair value gap. So when the fair value gap was created, a bearish candle moved into that fair value gap and then did what? Closed outside. So now the fair value gap is being respected, and when you see this candle right here, what does this candle represent? It represents a reversal candle, right? Reversal candle. Good. That means the price wants to do what? Continue going higher. And then as you can see, price then closes above the opening of that bearish candle. So when this bullish candle closes above this, now this candle from the high right here to the open, right, or from the open right here to the close right here, the body of that candle is your order block. Or you can take the high of the wick to the low of the wick as your order block, nobody cares. But then this candle is your order block because it went into an important level, that is a fair value gap, and then price closed over it, and now it turns into an order block. So what does that mean? It means that the moment it turns into an order block, you can enter from this the next candle's open. Right when the next candle opens, you enter there, you put your stop loss below this, or you can wait for price to come to this level, right? That's if price comes there. You can wait for price to come there, you enter from there, put your stop loss below this level. It's been marked invalidation because it means that when price comes below this level, it means that your order block did not work, right? And that means that price, it's either this low gets taken again and then creates another order block for a continuation upwards, or then it reverses and then comes and then destroys everything. So as you can see, the next candle did what? Went higher. You see how this candle then came into that opening that I talked about. So you can either enter when this candle opens right here, put your stop loss there, or either put your entry here, price triggers it, move higher. Right. So we have a fair value gap, an order block being created from a fair value gap. So you see the fair value gap was created, price came into that fair value gap, right, closed above the opening price, and then goes. This is another block. Now another form of another block can also be created from a high or a low. So in this example, we have a low right here, right? This low has liquidity, so then price takes that liquidity low, right, takes that liquidity low, and then that's what closes over it. Now it becomes an order block. This series of down close candles becomes an order block, and then price moves upwards. All right, so we are done with other blocks. So our next lesson is going to be on trading internal range liquidity to external range liquidity. All right, so far what we have learned, we are going to learn how to apply it with a model. So for whatever I taught you, it's not how to trade, it's just understanding the important levels that you would need to create a model. So we have ERL and then IRL model. The ERL means external range liquidity, and we have IRL, and that means internal range liquidity. Don't let the name scare you. External range liquidity is just the highs and the lows, right? And then the internal is just the fair value gaps, right? The fair value gaps. Take it from me. So we talk about the relationship between them. You see, this right here, right? This right here is the internal range liquidity, and then this low right here is the external range liquidity. So price takes the internal, sorry, price takes the external to the internal, so we take the external to the internal, right? So that's the relationship. Anytime that price takes out the external range liquidity, that's the low or a high, it then targets an internal range liquidity. That's a fair value gap, right? So we move from external, which is the lows or the highs, right? We move from the external after sweeping it into the internal. That's the fair value gap. And then when price gets into the internal, so now we move from the external, right? The external to the internal. And so when price gets to the internal, what is your target? Your target is the external. So that's the relationship between them. We move from external to internal, and then internal to external, external to internal, internal to external. So when price gets to the fair value gap, that's the internal. We expect it to what? To move to the external. Do you get it? So price moved from the external to the internal. So the external is what? The liquidity highs or lows, and then the internal is the bearish or bullish fair value gap. So price gets into the fair value gap and then do what? Move lower to the external. So now this becomes your external, right? So when the external gets taken, this external got taken into the internal. Now this one becomes your external because this is no more valid. This is your new external. Internal back to external, external to internal, internal to external. So if there was a fair value gap in between here, price would do what? Internal, right? So external to internal, internal to external. So the whole model is like this. So you have your higher time frame bias, right? So the higher time frame bias is either the market moving from internal to external, right? You expect the market to move from internal to external, or you expect the market to move from external to internal, right? And the stop rate happens. The stop rate is the liquidity sweep, right? Price goes above a liquidity high or low and then changes state of delivery, right? That is the stop rate. So it changes state of delivery, right? When it changes state of delivery, then you enter the trade, right? Please do not use this model. I'm not advising you to use it. I'm just teaching you. We will get to where we are going to use everything, right? I'm not going to advise you to trade this model yet. So this is what we mean. So you see from this external right here, you see this candle right here. What's this candle? It's a reversal candle. So on the higher time frame, price took out the low, right? This lower low right here, price took it out, and in our lesson we talked about this being a liquidity area. So price took out the liquidity there. That means it swept the liquidity, so it became a reversal candle. So when the market reversed like this, we expect it to do what? To move into the internal as our target. So now you are targeting the internal because we are moving from external to internal. So in the lower time frame, we expect a change in state of delivery. So you see this low right here, you see this line, that's the line right here. So the stop rate is the liquidity sweep that happens. So the market, a series of down close candles, went below that liquidity area, and then a series of up close candles closed above the opening of it. Now it causes what? Causes the change in state of delivery, and then the market does what? The reversal has been confirmed, and then the market does what? Moves upwards to that internal. I hope you get it. So we move from internal to external and external to internal. Alright, so I also need to make you understand that whatever that I'm teaching you now is leading towards the bigger picture. So I've not really went into deep into everything, as I mentioned to you guys that because this is going to be an all-in-one video, I can't put everything right in it, but then I'm teaching you everything that's necessary. So whatever that I've taught you so far, the fair value gaps, the other blocks, you don't have to apply it yet until we get to the model. All right, so now we're going to learn about ICT power of 3. What is power of 3? Power of 3 is accumulation, manipulation, and distribution. So you've heard me say liquidity sweep, liquidity sweep, liquidity sweep. Maybe you might be confused, right? Some might be a little bit confused. A liquidity sweep is just a manipulation over a high or a low. So when price goes above a high, and then it quickly moves to the opposite direction, or goes below a low and then it quickly moves in the opposite direction, that is what we call a liquidity sweep or a manipulation in that sense. So we are going to talk about power of 3, and ICT power of 3 is AMD. That is accumulation, manipulation, and then distribution. Every single candle, right? Every single candle, we like to think that every single candle has a power of 3. That's before a candle is created, there is an accumulation or a consolidation in that sense, right? So accumulation, and then that accumulation gets manipulated. So you see this accumulation right here. We have liquidity above this area, and then we have liquidity below this area too, because there is consolidation. So when price gets up here, people buy. When price gets up here, down here, people sell. So it's been happening, right? Up, down, and all of that. So there's liquidity above this area, there's liquidity below this area. So price needs to manipulate one of these areas to then move, right? So price manipulates the low, right? So this is a formation of what? A bullish setup. So price manipulates this low, that is the manipulation, and then it distributes. So the distribution is the expansion. So this accumulation is a consolidation candle. Let's say in a higher time frame, this becomes a consolidation candle. This manipulation becomes a reversal candle, and then this distribution becomes a directional candle. I hope you get me. I've been talking for a very long time, so I'm kind of having my throat hurting right now. Okay, so manipulation right here. So you see this low right here, this low right here, lots of liquidity right here. Market did what? Came below that low, and you see this series of down close candles right here, right? And you see this low right here. You see this low and these lows. What are they? Liquidity. Price did what? Came below. So you see this series of down close candles. What's the open right here? See, this is the open. So when price closes above that open, what do we call it? A change in state of delivery. Do you get it? Change in state of delivery. So now, when the market changes state of delivery, the reversal has been confirmed, right? So now it has to distribute. Since we have now confirmed the reversal, what do we expect? A distribution. So then it distributes. So even in this setup, we can understand the other blocks that I taught also. You see this is the fair value gap, right? This is the fair value gap. Price came into that fair value gap, they moved upwards. You see, this is the fair value gap. Price came into it and moved upwards. Price then later did what? Came back down. You see that this is not on that block, right? Because this is not a bearish candle. So this can't be another block. Okay. Price, this bearish candles came lower like this, right? So now we expect the price to go over this high right here and then confirm what? The order block. So when it came lower, price did what? Created bullish candles, but then it wasn't able to close over this. So another bearish candles was created too. Now these bearish candles then took out this low, and then went into another fair value gap too, and then price closed over them. So now we have an order block right here too. You see, order block because we closed above a series of down close candles. So now when price returns to that order block right here, the open of that order block, we expect it to do what? To go higher. Or when it closes like this, you just open your trade from the next candle open like this, and then you expect you put your stop loss here, moves higher. This is not what I'm teaching. I'm just trying to understand, see if you understood what I taught in the previous lesson. So accumulation, manipulation, distribution, that's what we call power of 3. So here is the higher time frame representation that I was talking about. You see the accumulation candle right here. So this low right here is the liquidity low, right? The previous candle's low has liquidity. So this manipulation candle takes out that low. So we have the accumulation, the manipulation, right? So this is a reversal candle, right? A reversal candle. You see how it took out this low and closed inside this candle's range. So you see from the high of the candle to the low of the candle is called the candle's range. That is the range of that candle. So this price right here, this candle right here, ran below it, right? And then it closed inside the range of that candle, right? So we expect the next candle to be the distribution candle. So now we have the accumulation, we have the liquidity here, price swept the liquidity, came inside, right? The manipulation, and then since this is a reversal candle, what do we expect? A distribution or an expansion in the next candle, and then it went higher. That's what we call the power of it. So this is the higher time frame representation of it. Okay, so this is the distribution. I hope you get it. The distribution candle supposed to look like this, the expansion candle in that sense. So in the lower time frame, this is how the expansion candle looks like. This is how the expansion candle. This is a bullish example. So this expansion candle opens well. So we've talked about these candles already. It opens here. It makes a low. Changes state of delivery. So when it opens right here and it comes to make this low, right? What happens here when price goes right? Change state of delivery, then it goes higher. These two become your order block. Fair value gap right here. These two candles, price close over them right here. Order block up. Good. So you can have different types of accumulation, manipulation, distribution. So this one, in this sense, we had the accumulation here, the manipulation here, the distribution, power of 3, 1, 2, 3. But sometimes it can happen in two candles whereby we have the accumulation, the manipulation, and the distribution is going to be in one candle, right? So it takes the low of that candle. So in the lower time frame, that's when you're going to see it properly. So let's say if this is the 4-hour time frame, you're going to see it well in the 1-hour time frame, whereby in the 1-hour time frame the accumulation candles will be there, and then the 1-hour time frame, part of the 1-hour time frame is going to show the reversal candle, and then the next candles is going to be the distribution. We will get there too. Exactly. So you see a change in state of delivery. So this candle right here, continuation expansion. So this reversal candle right here, right, that is what calls the change state, the change in state of delivery here. So this is the accumulation, right? This candle, the accumulation. So price went over this low, right? Price went below this low right here. The rent below it in this candle forms the wick. Change the state of delivery right here. Market goes above it. Change state of delivery. It means that the reversal has been confirmed. The next candle, what does it do? It opens, comes low here, another change state of delivery. So now this is called an order block. It's a change state of delivery, but then it's another block too, right? Price comes back, move. So another example, like the same example too. So this is from the reversal to expansion that I was talking about. So you see with this one, the reversal and the expansion is going to be in the same candle. The price took out the low of this candle, right? See, price took out the low of this candle. When it took out the low, the change state of delivery was confirmed, right? The moment the change state of delivery was confirmed, it means that price wants to move upwards, and then the order block 2 got confirmed right here. Price moved upwards. We are going to have more examples when we start practicing too. So exactly. So this is the ICT power of 3, right? The accumulation, manipulation, and distribution. So anytime there's an accumulation or a consolidation, we expect one side of the consolidation to be taken out, to be manipulated. So let's say this is supposed to be a bearish setup. Price will then go, when this accumulation happens, price will go above this level, take out the liquidity above this area, comes down, change state of delivery, and then move downwards. I hope you guys understand it. Alright, so our next lesson is going to be on phases of price. So we are now at the phases of price. So the price moves in phases. That means we have consolidations phase, we have reversal phase, we have expansion phase, and we have retracement phase. So the markets just can't move in an expansion and expand and expand. There's always going to be a retracement. And gold, for example, you see currently gold has been moving crazily, right? It's been expanding. But even in those expansions, you realize that the price makes retracements and then it expands later again. So we are going to talk about phase of price, how the market moves. So you have the phases. You have the consolidation, you have the reversal, you have the retracement, and then you have the expansion. So what is the consolidation? The consolidation is whereby the market is not moving in any specific direction. So it moves up, moves down, it moves up, it moves down, creating equal highs and equal lows mostly, right? And then we have reversal. So reversal is when price or the market takes a low or a high, right, and then changing state of delivery and move in the opposite direction. That is the reversal. And then we have retracement. Retracement whereby there has been an expansion, right, but then the market is now accumulating orders again. So the market then rests for a while and then it continues with the expansion. And this is the how the expansion looks like. You see, spans, right, without retracing or any other consolidation. So we have the phases here. So we have the expansion. After expansion, we have retracement. Retracement, you have reversal, consolidation, and it goes on. So it moves in cycles, right? We are going to have a perfect look at it. So what you need to focus on is that the market, when price is going from expansion to retracement, it is a continuation pattern. Do you get it? When price is expanding and then it retraces, it means that there is going to be another expansion, right? So the market just can't continue expanding. At least it needs to retrace for a while and then continue its expansion. So now there's going to be a continuation. So we call it expansion met with retracement is then continuation. So when the market is going from retracement, do you get it? So when the market is retracing, then it is going from retracing. Then we expect it to do what? Expand. So after a retracement, there comes an expansion. And so when the market is going from an expansion, right, when the market continues to expand and then it consolidates, right? So when the market is going from an expansion to a consolidation, it signifies either a continuation. So that continuation, right? So that consolidation can be used as the retracement, right? So when the market moves from an expansion to consolidation, it's signifying either a continuation or a reversal. Either a continuation or a reversal, right? And then the market is going from consolidation to expansion. What it needs to do first is either manipulate either side of the consolidation, right? As we talked about it in the accumulation phase of the power of 3. So it either manipulates one side of it, either the upwards or the downside, and then it moves in the opposite direction, or it breaks out of the consolidation. That's when it's going to expand. So when the market is going from expansion to reversal, right? Expansion to reversal, then what it means is that the market has been met with another expansion, and that means that there's a reversal. I don't know if you get it. If expansion is met with expansion, you see, when the market is going upwards fast and then it reverses faster, it means that expansion has been met with what? Expansion. And that is a reversal in the opposite direction. Alright, so we are going to take a look at the chart here. I'm sorry, okay, Akokobi Hanwa. That's crazy. Alright, so check the colors of this flow chart, right? So move in line with the current trend, move the opposite trend. So when you see the colors and then how it's being represented here, just know what we mean. So now the whole move with the expansion, because we are making our monies based on expansions, right? So when the market is expanding and it retraces, the next thing we are expecting is expansion. That is the continuation of that expansion. So when we are in a downtrend and then it retraces, we expect the market to do what? Continue moving down after the retracement. Or when the market is in an expansion phase and then it consolidates, we are still expecting it to do what? To expand. Now that expansion can either be framed from a reversal, that's it can, since it's a consolidation, either high or low can be taken, and then when the chain state of delivery is formed, it can move in the other direction. So when the market is expanding and a retracement happens, we are expecting the market to continue its expansion in that direction. Or when the market is expanding and then the consolidation happens, then we need more information, right, to see either the market breaks out of that consolidation and then continues the expansion in that first direction, or creates a reversal signal, manipulates either high or low of that specific consolidation, and then either move in that expansion, the first expansion's direction, or then the other side. So after a consolidation is an expansion, of course, and when an expansion is met with an expansion, that is what we call a reversal. I hope you get it. So expansion, retracement, expansion, expansion, consolidation, expansion, consolidation, expansion, expansion, expansion. That means it's a reversal, because expansion has been met with another expansion in the opposite direction. So there we have it. You see, expansion, and then retracement. So the market has done what? The market had expanded here. So the market expanded here and then it retraced. So when it retraced, it did what? It expanded again. So expansion, retracement, expansion. Or consolidation. That it can do two things: either breakout or manipulation. So the market expands, right? So after the expansion, we have a breakout. You see, expansion, a breakout here, right here. You see, market closed below this series, this up close candle. So then it becomes an order block, right? Move lower. So expansion, consolidation, breakout, expansion. Or expansion, consolidation. So in this consolidation, you see we have a manipulation up here. So expansion to the downside, consolidation, and manipulation to the upside, change state of delivery to the downside, and then continues the expansion lower. So this is a reversal sequence whereby there's a consolidation and then the market gets manipulated, change state of delivery happens, and then the price continues going lower. So that is expansion, consolidation, expansion. So now you have expansion to reversal. You see the market expanded and it was met with another expansion. So now this expansion to expansion is now a reversal, because if the market was moving higher and then it got met with another strong move lower, it then becomes a reversal. Because if the market was supposed to move higher again, then it would have either retraced or consolidated, at least not met with this strong move. So if the move is this stronger, then it means that the market has reversed. So this is the whole picture of it, right? So you have expansion, a retracement, expansion, consolidation, right? So when the consolidation happens, you see the market expanded, and then when the market expands, you don't expect it to continue expanding. So anytime the market expands, you need to allow it to form a retracement. So when you see a stronger higher time frame candle, don't make the mistake of thinking that the next candle is supposed to be stronger too. In fact, since the market just expanded, the next candle is supposed to be a candle of retracement. Then you look to trade the next candle that is going to form the expansion. This is something no one will tell you. You have this thing in those pattern traders that call it three black cross, whereby when you see three black candles, it means that the next candles are going to follow that same tribe. That means that these three candles were, strong bearish candles, it means that the next candles are going to be bearish. Of course they can be bearish, but then what is going to happen naturally is that was expansion, that were strong expansion. So the market needs to at least retrace before it continues downward. Just don't enter because you think the market was bearish. So I hope you get it. Let's look at this example. You see this candle right here, 1 2 3, right? Very, very strong candles. But you see what happened next? Retracement. Before, let's say, it went down again. Anyways, let's continue. So the market expands. So when the market expands, you expect a retracement. So after the retracement, and then you enter again for it to continue expanding. So when the market expands, it can't expand for a very long time. That's in the same direction. So then it's going to consolidate. The market consolidates, and then now comes a reversal in the opposite direction. So after the consolidation, we have the manipulation, and after the manipulation we have another expansion and another retracement, another expansion, a consolidation, a reversal formed right here, change in state of delivery, expansion. So the picture that I'm trying to paint here is that when there is an expansion in the market, you need to allow the retracement to form, because that is what is supposed to happen. After every expansion, there comes a retracement or a consolidation, or if you have no luck, a reversal. So you don't just see expansion and want to trade the next candle too because you think it's going to expand to. No, when there's an expansion, probability that the next candle is going to it's like the market is tired. You see, when the market expands, it's like it's tired, so it needs to rest for a while before it continues its journey. So after an expansion, we expect a retracement. That's if you are going to continue the expansion, or a consolidation, or even a reversal. So this is the phases of price. So you blend it all together, whereby expansion, retracement, expansion, expansion, retracement, or expansion, consolidation, a reversal, expansion, retracement, expansion, retracement, expansion. So it's all based on expansion and retracement, consolidation, expansion and retracement. Do you get it? So this is the phases of price. And then we are nearing the end of the foundation to the model. Alright, so our next lesson is going to be on time frame alignment. Time frame alignment. So here's our lesson on time frame alignment. So what is time frame alignment? You see, the market is we learned the phases of prices. It means that the market is in phases and it's in stages and it's in steps. You just can't move from the daily time frame and then your next lower time frame is the 5 minutes time frame. It doesn't work that way. It is mechanical. See, it's systematic and you need to follow it too. So I want to talk about the time frames in which you need to align your trades when you are trying to use your model. Right, so you have top-down analysis. So you have what we call bias. When we say bias is the direction of the market. So it's either the market is in an uptrend or it's in a downtrend, and the bias is where you think the market is moving next. So you need one time frame to determine your bias, and most of the time that time frame is the higher time frame. That's the weekly time frame, the daily time frame, and sometimes the 4-hour time frame. Okay, and then we have the narrative, right? Or let's say the structure. So after determining your bias, you need to see the structure of the market. You see the daily time frame, right? So when you are trying to trade one specific daily candle, that daily candle only tells you what the previous candle was like. So you need to go into that previous candle's structure, that's the lower time frame, to determine how that candle looks like. How that candle formed. You see, so let's say this is the daily time frame for your bias, right? This specific candle right here, you will need to go into another lower time frame to see the structure of that specific candle and how it formed. So another time frame for the structure, and then we have another time frame from the entry. Sometimes people can enter from the structure time frame. Sometimes too, people want to enter from the lower time frame. That's lower than the structure time frame, right? So your bias, your structure is the narrative, right? The story behind it and all of that, how it's going to form and how you are going to trade in the lower time frame. The lower time frame is for the entries. So the higher time frame, the intermediate time frame, the lower time frame. All right, so this is the time frame alignment chart. That's, you have the weekly time frame. So when your bias or structure is from the weekly time frame, we are looking to trade on the 4-hour time frame. And when it's from the daily, you are looking to trade on the 1-hour time frame. When it's from the 4-hour, you are looking to trade on the 15 minutes time frame. When it's from the 1 hour, you are looking to trade on the 5 minutes time frame. When it's from the 30 minutes, you're looking to trade on what, the 3 minutes time frame. And when it's from the 15 minutes, you're looking to trade on the 1 minute time frame. So one can use the weekly time frame as a bias, right? So you have the weekly time frame as your bias, and then the 4-hour time frame for the structure, and then the 15 minutes for what, for your entry. I hope you get it. Or the daily for your bias, the 1 hour for your structure, and then the 5 minutes for your entry, and so on and so forth. So you can see here weekly 4-hour, right? It's what's happening, sorry, weekly 4-hour 15 1 minute. I hope you get it. So daily 1 hour 5 minutes. Good. So this is just about a time frame alignment and how to align your trade. So you just can't move from daily and then straight into any 1 minute or 15 minutes. Do you get it? So you have an example here, right? So this is your bias. Your bias is what? Moving from this external to the internal, right? So now you have to go for your entry, right? So the entry is where you are going to see the change date of delivery and all of that in the lower time frame. I hope you get it now. Alright, so this is the so you can take a screenshot of this. Thank you. Alright, so we are at the end of the video, right, of the lesson. And then please, if there are any questions, we are going to have live sessions. You can ask me any question after you are done with this video, so in my DM or in the group too. You see, this was quite a quick video, and so maybe you might not understand something, but then in case you are confused, you see, I haven't taught any model yet in this trade. That is because I just want you to learn the individual things that I've taught here, and then we are going to apply them in the model. I didn't bring out the model in this video because I think I'm actually tired and I want to rest for a while. Probably soon I'll drop the model too, and then we'll start everything soon. Okay, so this video that I made was for you to understand the individual things, that the fair value gaps, what a fair value gap is, the other blocks, the change state of delivery, because I'm going to mention them a lot, the strength high and all of that. So you needed to understand them, for the greater good, So thank you guys very much for watching to the end, and if there's anything, just contact me and then we'll talk about it. All right, take care.